Welcome to CHI Bota's YouTube channel. Today's topic is 30% US exit tax that can tax your pension twice. So let's get started. Who is going to be affected? Let's say you are working your whole life in the US and saving into pensions such as 401k. Then, whatever reason you decided to leave the US as a covered expatriate. I'm not going to explain who the covered expatriate is. Let's say some become a covered expatriate, others will not. So let's assume that you become a covered expatriate and suddenly you face double taxation on your pension. And that's the topic today. Let's dive into a little more concrete example. You're a green card holder with a US pension. You leave US in next year, early next year, 2026, and give up your green card by filing I-407 to USCIS with your green card. Then take a pension distribution in 2026. Now, let's say you decided to take a big amount, $100,000 out of your, let's say, $500,000 pension asset left in the US. All of a sudden, IRS takes $30,000, which is 30% of your distributed amount of your pension of 2026, and you receive only $70,000. This is like a tax, income tax or social security tax withheld from your salary when you're working in the US. And this is a mechanism that you only receive $70,000. So why this becomes a double tax trap? In the US, 2026, as I explained, 30% exit tax is withheld from your pension income. In your resident country, 2026, you file your 2026 tax return. Resident country taxes pension income. And unfortunately, credit often denied, meaning, in the plain language, even if you say to your resident country that you already paid taxes to your pension income to the US, resident country denies the credit, doesn't recognize the credit. So it ended up same income, two countries, two taxes. Now, why this happens? Well, countries disagree on what US exit tax actually is. And the question would be, is that an income tax, wealth type of tax, or penalty? Covered expatriate should have net asset over $2 million. And, is it a wealth tax or is it a penalty imposed by the US government? And countries often disagree on the on the question of if the exit tax is an income tax, and they often disagree. So here, what's happening is treaty and resident countries' domestic law really, balances out or challenges each other. In other words, there is a clear conflict. So what are your solutions? Treaty solution number one, foreign tax credit. Number one, treaties, let's say US, UK tax treaty, US Canada tax treaty, US Germany tax treaty exists to prevent double taxation. That is the main goal of the treaty. 30% of pension income is, in a way, it's an income tax because you get a pension income, you receive a cash and 30% is taken out. Isn't it a type of income tax? And pensions are very important source of income for a lot of people, and treaty have a specific section article protect pension income. However, like I said, foreign tax credit often denied. And treaty solution number 2 is treaty relief through negotiation. So this process actually, U.S. Model Income Tax Treaty Article 25, it is used when domestic law blocks treaty relief, government to government resolution, and used when domestic law blocks credit. And it's a little bit repeated point from the first point, but please excuse me. So treaty override takes years, not guaranteed, and very expensive. I want you to be well aware of the realities of treaty solution number 2. So let's go to the case study in Japan. So you become a covered expatriate and you take the pension distribution, 401k distribution, and you only receive 70%, 30% withholding, and Japan denies foreign tax credit. And let's say you pursue treaty-based relief, but it's not automatic and it's rare, and therefore, your credit is denied. So Japan is a good example, and they often does not treat the U.S. exit tax as an income tax, which means foreign tax credits are commonly denied. At least that's what I heard recently from tax professionals who lived and work in Japan. So who this matters to? Number 1, covered expatriate. And if you're not sure if you're gonna be a covered expatriate, you should find out. And then green card holder planning to leave, or U.S. person planning to leave and expects to renounce your U.S. citizenship. And also, if you're living in the U.S. and green card holder or U.S. citizenship with a 401k or other type of state pensions or school type of pensions and so forth. Therefore, as a final word, if you're covered expatriate with a pension, this is not something that you can fix after you leave. Often, the exit tax is triggered, your options become limited, slow, and expensive. Planning before expatriation is a key difference between one tax and 2. And therefore, please book a consultation with us. And this is a link. Here is a link for complimentary consultation. And this is our email address. So either way, you can book a consultation or you can send us an email and to discuss your particular situation. Important thing is planning before expatriation is a key difference. That's all, and have a wonderful day. Thank you very much for watching. Bye.